Confirming its full-year earnings forecast. With us now, D.A. Davidson retail analyst Michael Baker. Michael, great to have you on. I want to get your thoughts on this conversation we were just having with Steve and how it's playing out, whether it's this idea of margin compression as inflation begins to come off, whether it's this idea of the consumer mix shifting and fueling growth at a name in grocery at a name like Walmart. Your thoughts on what we're seeing play out from a macro level, on the micro level, through the retail results we've gotten so far?
Well, sure, yeah, and I think the highlight of the day is certainly Walmart, and we think their ability to take market share, particularly with higher end customers, and that is a function of somewhat distressing economic environment that we're heading into, and it is forcing customers to think about where they shop differently, and Walmart is well positioned to take care of that. The most important thing we saw today, I think, was their inventory levels come back, really cut in half, up only 12% versus 25%. Last quarter, and that's really what I think is going to be the key throughout the earnings season, is taking a look at those inventory levels. Up 12% versus sales up closer to 9%. It's not really too much of a glut anymore. They've really done a great job working that down. To the question about margins and how that plays out next year, I think that is a key question, and the idea of will retailers be able to hang on to prices as some costs come down. Both Walmart and Home Depot were asked that on their conference calls, which just ended, and neither are really being overly bullish or getting too far ahead of themselves in terms of predicting better margins next year. And I think that makes sense. You don't want to be out there saying that you're going to hold on to higher prices even as some input costs come down. But we do think it could be a little bit of a margin benefit next year relative to the big drag that we've seen in retail margins this year.
Interesting. Let's dig into Home Depot a little more right now, because we have seen the housing market soften aggressively. Is that a forward-looking indicator for activity at Home Depot? Or if you have more people staying put in their homes because interest rates have risen as much as they have over the past year, is it a beneficiary?
Yeah, sure. Well, I think Home Depot's done amazingly well in this environment, which does seem to point to some slowing demand in that category. So we give them all the credit in the world. And I do think that as people stay in place a little bit more, that could help business. But in general, home price appreciation is the most important metric. Home prices are up certainly, about 40% in the last 3 years. But those increases are starting to moderate. We think the bar is just set a little bit higher here for Home Depot, given the Fed backdrop, which is still a little bit of a headwind. And so they had great results, but it's tough for that stock to work here as long as rates are going up. And again, we think that'll lead to lower home price appreciation looking ahead.
So how does all of this set us up for more retail results this week, with Target in particular in focus tomorrow, given, back to your earlier point, the inventory drawdown we're seeing at Walmart?
Yeah, watch the inventories, and pressure's on Target a little bit here. Walmart certainly did a great job working down the inventories. We expect to see the same from Target. We've seen a lot of markdowns. We know that the retailers are ordering less, so the inventory levels should be better in the third quarter than they were in the second quarter. We don't know if Target will show quite as much progress as Walmart did, just because of Walmart's mix to non-discretionary items. But that's really the key metric to watch tomorrow for Target, is their inventory levels.
Okay. Michael Baker, thanks for joining us.
Happy to do it. Thanks.